news coming out of Kenya. Kenyans will continue to wait for cheaper flour after it emerged that the government's search for cheap maize was facing headwinds on limited supply of the grain on the international market. Ministry of Agriculture has opened negotiations with traders aimed at reviewing the 4,200 shilling per 90-kilo bag that the government had issued to maize importers as the landing price under a duty waiver. Agricultural Principal Secretary Harsame Kelo says it has become difficult for traders to find cheap maize owing to a tight competition with other African countries such as South Sudan, which is offering higher prices. Kenya's external debt has ballooned by 344 billion shillings, to giving dimension to the impact of a weakening shilling, whose exchange rate against the dollar has hit a historic low of about 133. Central Bank of Kenya shows that total external debt as of January stood at $37.63 billion. That's about 4.7 trillion shillings, where the mean exchange rate was 124 against the dollar. By February, National Treasury had paid about 694 billion shillings for debts, an increase of 27 billion in the same period last year, with part of the increase being attributed to the weakening currency. Still more news coming from Kenya. The average commercial bank lending rates in Kenya has breached the 13% mark for the first time since July 2018 in the wake of the Central Bank of Kenya's benchmark rate hikes and rising yields on government paper. According to the Central Bank of Kenya, data showed lending rates jumped from 12.7% in January to 13.06% in February, highest level in 58 months. Expensive credit is set to put loans and mortgages higher and maybe out of reach for many individuals that could hobble corporate investment in Kenya's economy. Senior citizens, more than 82% of senior citizens are working for basic needs amid financial struggles in Kenya, raising concerns about the adequacy of pension payouts and coverage of retirement benefits. Kenya National Bureau of Statistics quarterly jobs report showed that 776,000 out of 869,000 people above the age of 60 were in active employment in December, representing an 82.1% of senior citizens in the nation. Many of those working were doing so to meet basic needs. Joining us to discuss further, Johnson Nderi, who is head of research at ABC Capital in Nairobi. Johnson, thank you so much for joining us. Good afternoon to you. I want to start with that jobs data from the KNBS, 80% of senior citizens still working. What type of picture does that paint with respect to the employment in Kenya?
Past few years, the cost of living has been rising, and therefore, everybody was trying to keep up. So you don't want to retire because that means that your economic future will be put into jeopardy. Therefore, people want to work because that's how they believe they can get by better.
Now, what's the state of Kenya's pensions and retirement benefits? Is there not enough revenue to cater to senior citizens?
So, the problem is that sort of income is like fixed income. So you have a problem with fixed sort of income when prices are rising. But if you're employed, you see you can get better, higher incomes, and consequently a better living standard, and therefore it makes more sense to stay in employment than going to into a position where your income is sort of fixed in an environment where prices are rising.
Now, I want to ask you about Kenya's Public Service Commission Act. It was, I guess, there were a couple amendments that were made in 2009 and 2020. So the retirement age was raised from 55 to 60 in the 2009 amendment. And then in 2020, retirement age for disabilities, that was raised to 65 from age 60. But as recently as February of this year, the Public Service Commission said it wouldn't raise the retirement age again because there were still a lot of requests. Is the pressure is there going to be continued pressure on the government to raise the retirement age?
Yes, and that's likely because of the idea of raising rates the retirement age is for government to save, because when these guys go into retirement, that's an additional cost to the government, and yet they still have to hire to replace the staff that has left. So those are double costs. So you'd rather maintain the ones you have, and if you look at it globally, it's a trend. France are raising it. You can see the riots as a result of that. US have had the same sort of medicine to manage their fiscal position. So it's nothing new. It's just a method of government to postpone reckoning, because when these guys retire, they have to be paid their pensions, and the government is not keen on that. They'd rather postpone that eventuality.
Now, it's been said, I want to move to the lending rate now, because most of these seniors that are still working, the senior citizens, they're doing so, it says, because to meet their basic needs. Now, how do you meet your basic needs if you've got a lending rate now that's at a 5-year high of, I think, 13.06%? What's the impact of this lending rate continue to rise in terms of access to loans and so on, and cost of borrowing?
So the cost of borrowing was always going to go up, and the reason for that was because cost of government debt was always going to go up, and or was rising anyway. And lending is pegged against government borrowing, because even banks compete for deposits against government debt prices, right? So that's a very useful benchmark for pricing. So what the central bank did when they quote unquote raised the rates is essentially signaled to the market that they're going to tighten monetary policy because they want to bring inflation under control, and it's been running hot. I think we're at 9.2% year on year for the month of February. So we have to manage that, and the inflation premium was causing interest rates to rise anyway. Fiscal problem was also government's fiscal position is also forcing interest rates to rise. So all those three factors combined were always going to raise interest rates. So for me, it's secondary. What is primary was if the government brings its fiscal position under control, I think interest rates will fall.
Okay, I'm glad you said, because you preempted my next question about interest rates falling, because I was going to ask if you anticipate more rate hikes as the government continues to try to fight inflation with monetary policy.
Certainly, because I believe there are two factors that have been driving inflation in our country, and the number one is the drought, because food is a big chunk, is a big proportion of CPI. So if productivity can go up or can improve, then you can bring prices under control. The second issue is monetary policy, and I believe CBK has been supporting the expansionary fiscal policy of the government, and as a consequence, prices started running hot. So now they have to dial that back. How quickly they bring inflation under control is a good question, because also the government is facing its own issues with regards to solvency as a consequence of high borrowing costs. And I know I don't know if we've spoken about this about the government debt, but the most expensive part of government debt is the local component, and I think it constitutes about 80% of debt service, largely because a lot of people have been shortening their maturity profiles of their bond portfolios, because there's concern about lending the government long, and consequently, they've been trying to manage that risk, and as a consequence, it's raising the government's debt service costs, because then maturities now are more short term, and the government is having to pay this regularly, and it's impacting government's cash flows. So interest rates. I think the first thing the government will be focused on is trying to bring down cost of borrowing by managing its fiscal position. And if they're able to do that, and at the same time manage monetary policy, which is quite difficult, I imagine, then maybe we'll see a light at the end of the tunnel.
Now, since you mentioned the debts, I mean, cash flows are impacted. What about the impact on capital expenditure, projects, infrastructure, and so on? If you're servicing debt that's so high, I guess opportunity cost, isn't that going to limit how their impact? I mean, limit their ability to be able to spend more on capital expenditure and so on?
So it's a question of choose your poison, right? Because also inflation as is impacting capex spending, because you're going to import manufactured equipment with the shilling depreciating quite rapidly against the dollar. So it's causing a lot of consternation in the business sector as a consequence. So I think it's a question of do you want a weakening shilling or higher interest rates, and maybe a high interest rates make more sense, because in some cases the rates are only rising for government, and I've seen the government has been trying to secure some syndicated loans on the basis of SOFR plus 500 basis points thereabouts, and I've seen a number of private enterprises securing loans at exactly the same price. So maybe some of the risk on higher interest rates is because of government's credit worthiness in itself, and therefore maybe it makes more sense to defend the shilling than to try to stimulate the economy with low interest rates.
Speaking of defending the shilling, just I think final question for you. Food prices rising. You mentioned food inflation earlier. This flour scarcity and this competition to import flour into Kenya. What's the impact on agriculture, staple foods like bread and so on?
So because we import a lot of our wheat, for bread, for example, we are probably impacted more by shilling strength and availability of wheat in the open markets, and this is largely from Ukraine, Egypt, I believe, and Russia. But because we eat more maize, because we love our ugali. If you've been to Nairobi, I should take you out for some ugali.
For sure.
Because of that, maize is of a larger focus, and the drought have impacted our production, and so of which constitutes a huge part of our consumption. So the rest we import, but again, the drought was felt, in large swaths of this region, and therefore there was competition for maize, even within the producers themselves, like Zambia, which has been a big source of our maize, Malawi and Tanzania, and those limited their exports. And that's where we had a double whammy, both from local production and from international availability. of the produce.
Johnson Nderi, Head of Research, ABC Capital. I'm coming over to Kenya to try that ugali. Thank you so much for the invite. Thanks for taking us through the latest news coming from East Africa's giant.